Welcome to The Deep Dive, your shortcut to being truly well-informed.
Hey there.
Today, we're digging into Flex's first quarter fiscal 2026 earnings call. Now, Flex, they've been this global giant in design, manufacturing, supply chains for years, often kind of behind the scenes.
Right, a huge player, but maybe not always the flashiest name.
Exactly. But this quarter, their earnings call really painted a picture of, well, a company changing shape, moving fast, to be right at the center of this whole AI revolution.
It's a fascinating shift.
So our mission today is simple. Unpack the key numbers, the strategy talk from management, and figure out what it all really means for your understanding of where things are headed.
Absolutely. It's more than just the numbers themselves. It's about the story behind them, the strategic moves they're making, and what that signals for Flex, going forward. And this quarter gives us a really clear look.
Okay, let's kick off with the headline results then, because Flex really had an exceptional Q1 for fiscal 26. I mean, really set a strong tone.
They certainly did.
Revenue came in at $6.6 billion. That's up a solid 4% from the same time last year.
And importantly, it wasn't just top-line growth. Their operational side looked really strong, too. Adjusted operating margin hit 6%. That's robust, shows good discipline.
Right, but the number that really jumped out, I think, was the adjusted earnings per share.
Oh, yeah, that was the big one.
72 cents. A record Q1 for them. And get this, up over 40% compared to last year.
Over for 40%. I mean, that's the kind of growth that really makes you sit up and take notice.
Wow. Yeah, a 40% jump in EPS.
Wait,
that's huge. That kind of start must give them a lot of confidence about hitting their full year goals, right?
Absolutely. It definitely boosts confidence. And, you asked if it's just them or an industry wave.
Yeah, is it just good execution, or are they riding this massive AI tide?
I think it's probably a bit of both, but the execution story is really strong here. This wasn't just luck. It feels like those strategic bets they've been making are really starting to pay off now.
Okay, so let's dive deeper then. Go beyond the headlines into the core financials for the quarter.
Let's do it.
All right, so gross profit landed at $596 million. And what caught my eye was the gross margin improvement, up 130 basis points to 9.1%. Maybe quickly explain basis points for listeners.
Sure thing. Yeah, 130 basis points just means 1.3 percentage points. So margin went from 7.8% up to 9.1%.
Okay.
And that jump tells you they're managing costs well, but also probably shifting their mix towards, higher value stuff. They're not just selling more, they're selling smarter.
Right, selling smarter. And that flows down, doesn't it? Operating profit hit $395 million, expanding those operating margins by 120 basis points. That's 1.2 percentage points to 6%.
Exactly. Consistent improvement.
But here's where it gets really interesting, I think, on the cash side. Free cash flow for the quarter, an impressive $268 million.
Mm-hmm.
That represents a 98% conversion rate from net income. That's just remarkable efficiency. What's driving that?
It really is a standout number, a 98% conversion. I mean, almost every dollar of profit turns straight into usable cash. A big piece is definitely their inventory management.
Yeah.
Net inventory was actually up a bit, 3% from the last quarter, which you'd expect as they ramp. But critically, it was down 11% compared to last year.
Down 11% year over year. Wow.
Yeah, and they cut inventory days down by 7 to just 55 days. That means less cash tied up in stock sitting on shelves. It frees up that capital.
So tight operations driving strong cash. And how are they putting that cash to work?
Good question. Capital spending, CapEx, was $131 million, about 2% of revenue. Pretty standard, manageable spend.
Yeah.
But significantly, they kept buying back stock, about $247 million worth, roughly 7 million shares in the quarter.
That's a decent chunk. Signals confidence. Right. Management thinking the stock's a good buy.
Exactly. It's a strong signal about how they view their own valuation and a commitment to returning value to shareholders.
Okay, so really strong Q1, operations look tight, returning cash. But the big question is always, can they keep it going? What's the outlook for the full year? Did they update the guidance?
They did. And it's interesting, they actually raised the full year revenue outlook, now expecting between $25.9 billion and $27.1 billion.
Okay, that's a raise.
Yeah.
How much at the midpoint?
Raises the midpoint by about $600 million, so a pretty decent bump up.
$600 million.
Okay, but here's the twist. While revenue guidance went up, the adjusted operating margin guidance stayed put. Still 6% to 6.1%.
Okay. Higher revenue, but flat margin percentage. That seems odd. Why wouldn't margins go up with more revenue?
Yeah, it does seem counterintuitive at first. Management actually addressed this on the call. They said part of that higher revenue includes what they call low-calorie pass-through tariff costs.
Wow, low-calorie revenue, like eating celery fills you up, but not much substance.
Huh, pretty much, yeah. It means costs, like tariffs, that they just pass straight through to the customer. It boosts the revenue number on the books, but adds very little, maybe nothing, to their actual profit margin.
Got it. High volume, low profit contribution.
Exactly. So that explains part of it. And the other part is they're planning for increased strategic investments later in the year.
Ah, okay. So they're reinvesting some of that upside.
Right. Choosing to plow some of that extra revenue back into the business for future growth instead of just letting it all boost the margin percentage right now.
That makes sense. Strategic deployment. What about the bottom line, the adjusted EPS guidance?
That's now expected between $2.86 and $3.06 per share.
Okay, so they raised that too, but Q1 beat by a mile, over 40% growth, but the full year midpoint raise was, what, 5 cents?
Seems a bit cautious after such a huge Q1 beat. What's the thinking there?
Right. It does seem a little modest compared to Q1's fireworks. Management pointed to a couple of things. One, an expected increase in their interest in other expense line. That hits the bottom line directly.
Okay, higher cost there. And second, they mentioned a favorable comparison effect in the first half. Basically, they had some absorption issues last year. Think inefficiencies or underused capacity that made costs look higher then.
So this year looks extra good by comparison, especially in Q1, an artificial boost almost.
Sort of, yeah. It amplified the Q1 growth percentage, but that effect won't necessarily repeat all year. And again, those planned strategic investments also eat into some potential EPS upside for the full year.
Got it. So managing expectations a bit. Despite all that, though.
Despite that, the adjusted tax rate looks steady at 21%, and they reiterated that commitment to converting over 80% of net income into free cash flow. That 80% plus target is really key for them long term.
Absolutely. Okay, let's pivot to strategy because the data center business is just exploding for them, isn't it?
It really is. It's clearly the core focus now. They're projecting about $6.5 billion in revenue from data centers this fiscal year.
$6.5 billion and grow them at least 35% year over year.
Yep. That makes it about 25% a quarter of their total revenue. Just massive.
What makes this business so compelling for them beyond just that huge growth rate?
Well, it's the nature of their offering. It's really comprehensive. On the cloud side, think IT hardware infrastructure. They're doing vertical integration.
Meaning
they do everything from bending the metal for racks to assembling custom server racks. Even sophisticated stuff like direct chip liquid cooling, basically building the guts of the data center.
Okay, the physical infrastructure.
Right. And then on the power side, they cover the whole spectrum, from tiny power modules on server boards right up to huge facility-level modular power pods that manage energy for the entire site.
Wow. So they're really aiming to be the one-stop shop for building these massive AI and cloud facilities. They actually highlighted themselves as the only provider doing both end-to-end cloud IT integration and the full power and cooling portfolio at scale.
That's their big claim.
They call it grid to chip. That's a powerful phrase.
Yeah.
Can you unpack what that really means for a listener? What does that scope cover?
Sure. Imagine the electricity grid feeding power into a huge data center campus. Flex's solutions manage that power flow, condition it, distribute it through the facility into the racks onto the server boards, and deliver it efficiently and coolly right down to the actual processor chip.
So literally from the main power input all the way to the silicon.
Exactly. They're building and managing that entire physical ecosystem that lets AI actually work. It's not just one component, it's optimizing the whole system. Power, cooling, compute infrastructure, all integrated. That's critical for AI's huge demands.
And they believe they're unique in offering that full scope at scale.
That's what they emphasize, yes. And if true, that's a significant competitive advantage, a real moat.
Okay, within data centers, they mentioned expecting power solutions to grow faster than cloud solutions this year, year over year. Why is that?
It's mainly down to comparisons. Power apparently had a softer year last year, maybe lower growth or even a dip. So the year-over-year growth percentage looks stronger now just because the starting point was lower.
Ah, the base effect. Makes sense.
Yeah. But both cloud and power are expected to contribute significantly to hitting that overall 35% plus data center growth target. The demand for both compute infrastructure and the power and cooling to run it is just surging.
Right. Now, what about the big cloud providers, the hyperscalers? There's always chatter about them bringing capabilities in-house. Amazon made some noise about cooling recently. Does that worry Flex? Does it make them less essential?
That's a really important question. Interestingly, Flex framed things like the Amazon announcement as a positive thing, like validation.
Validation, how so?
Their take is that it validates their own technology and product focus in areas like cooling. They argue that even if hyperscalers design some things internally, the sheer scale and complexity of global data center buildouts mean they'll still need partners like Flex with the manufacturing muscle and the integrated system know-how.
So even if Amazon designs its own cooling, they might still need Flex to build or integrate it at scale.
Potentially, yes. Or it just reinforces the overall trend that advanced integrated solutions for compute, power, and cooling are critical. Flex seems confident their grid-to-chip offering and their global execution ability keep them vital, even indispensable in this build-out. It's a fine line, but that's their position.
Interesting perspective. Okay, let's talk about their global footprint and regionalization. That's another big theme. They have this massive scale, 49 million square feet globally.
Yeah, huge, including 7 million in the US, 9 million in Mexico.
How does that scale actually help them compete? What are the benefits?
Well, combined with their investments in things like AI for their operations, automation, and building up local supply chains, it gives them incredible flexibility.
Flexibility, how?
They can shift complex manufacturing between regions. That's huge for dealing with customer demands, tariffs, geopolitical issues, supply chain hiccups, you name it.
And they've been actively shifting, right,
Yeah.
towards regionalization.
Oh, definitely. They've been leading that charge. You can see it in the numbers. America's revenue climbed from 38% in fiscal 20 to 49% in fiscal 25.
Wow, nearly half the revenue now from the Americas.
Yeah, while Asia dropped from 41% down to 30% in the same period. That's a major rebalancing, adapting to how the world is changing.
A really significant strategic shift. And speaking of strategy and regions, they made a key investment recently that fits right into this.
Yes, that acquisition of a new manufacturing site in Poland.
Right. Tell us about that.
It's a prime example of putting capital behind strategy. It literally doubles their capacity for making power solutions in Europe.
Doubles it. Okay.
Yeah. Directly addresses that booming demand for data center power over there and fits perfectly with customers wanting more regional production in Europe.
So they're clearly investing hard to keep pace with data center demand. Are they struggling to keep up, or are they managing capacity okay?
They're actively investing, yeah. That Dallas facility is ramping up. Poland adds a lot. Their goal, they said, is to have just enough capacity.
Just enough. Sounds like walking a tightrope.
Well, it means they want to meet demand and shorten lead times for that 35% data center growth, but without building way too much capacity ahead of time and wasting capital. It suggests they're trying to be quite disciplined about matching investment to actual visible demand.
Right, the balancing act. Okay, data centers are the star, clearly. What about their other businesses? Anything interesting happening in their other end markets? Any green shoots or weak spots?
Yeah, they give some color there. Generally, demand trends outside data centers are tracking pretty much as they expected. No huge surprises.
Okay.
For reliability solutions, that's automotive, industrial, renewables, revenue was down just slightly. Automotive still facing some macro pressures, maybe softer car sales, and renewables have had some policy headwinds. But strength in power components within that segment helped offset some of the weakness.
Got it. And the other main group, agility solutions. That's cloud, AI, telecom, consumer.
Right. That segment saw strong revenue growth, but it was really driven by the cloud and AI piece, as you'd guess.
Makes sense.
That strength offset continued softness in traditional telecom infrastructure spending there is still kind of slow, and also in consumer-facing markets, which remain pressured.
Any bright spots outside AI cloud?
They did mention seeing some green shoots in infrastructure-related industrials, maybe some early signs of foundational spending picking up there. And healthcare devices perform strongly, which is usually a steadier market. Automotive, as we said, pretty much tracking their initial conservative view. So a mixed bag, but the data center engine is clearly pulling the train.
Okay, so let's tie this all together. What does this earnings call really signal for you as someone watching the company or the sector? It feels like Flex is really undergoing a transformation.
Absolutely. It underscores a company that's not just reacting, but actively pivoting, strategically transforming itself. They're leaning hard into the future.
And their actions back that up, right? Yeah. Capital allocation.
Yeah, the share buybacks, targeted M&A, like that Poland facility. It shows discipline and a clear focus on growth areas while returning value. And that grid-to-chip focus, it positions them not just as benefiting from AI, but as a critical enabler. They're building the foundation.
Exactly. They're the picks and shovels, maybe, for the AI gold rush, providing the essential physical infrastructure. And their track record on regionalization and navigating tariffs.
Shows operational resilience. In today's messy world, that's huge. It suggests they have robust ways to handle trade issues and supply chain shifts, likely built into their contracts and operations.
So the big signal from this call seems to be that the demand for the actual physical stuff needed for AI and digital transformation is incredibly strong, even if other parts of the economy feel softer.
Exactly. It's a powerful story of a company adapting and aiming to lead in these massive global tech shifts. Puts them in a really interesting spot.
All right, let's shift gears. Time for our This Is Not Financial Advice segment. And remember, folks, this is strictly hypothetical for entertainment, definitely not a recommendation to buy or sell anything.
Absolutely. Purely a thought experiment.
So if we were brainstorming outrageous but plausible trade ideas based only on this earnings call, what might emerge? How about this? Long Flex, short, a pure play regional automotive electronics supplier.
Okay, long flex, short auto supplier. Lay out the thesis.
All right, the flex side is clear, right? Everything we just discussed.
Right.
Accelerating shift to high growth data centers, that unique grid to chip integrated solution, proven operational excellence, managing tariffs, regionalizing effectively. Their confidence in 35% plus data center growth seems solid, backed by investments like Poland. They look like a key enabler for computing's future.
Okay, that's the long flex argument. What's the short side? Why short a regional auto electronics supplier?
Well, Flex themselves gave a pretty cautious outlook for automotive, didn't they? Despite maybe some green shoots elsewhere. So the trade argues that Flex's strategic pivot towards next-gen infrastructure makes it a better place for capital right now than a company still heavily tied to the more cyclical, traditional automotive sector, especially one focused on maybe just one region, say Europe.
Right. So you're betting on Flex's superior execution in a high-growth market versus a company facing maybe lingering macro headwinds in auto, plus maybe disruption from the EV transition and perhaps less geographic or product diversification.
Exactly. It's a bet on the infrastructure powering the future versus a segment that, according to Flex's own tone, still looks a bit uncertain. It's about contrasting strategic direction and market momentum. Think about a smaller company, maybe heavily reliant on European car makers, facing both economic softness and that whole EV supply chain reconfiguration.
Got it. It highlights where strategic capital seems to be flowing for growth versus areas potentially more exposed to economic cycles or slower transitions. An interesting contrast.
So wrapping this up, Flex put up a very strong Q1. The data center business is booming, and they seem to be managing the broader dynamic environment effectively.
Yeah, those strategic investments in AI infrastructure, their global reach, that integrated grid-to-chip approach, it really positions them as a significant player in this whole tech transformation we're seeing.
We hope this deep dive into Flex's call gave you some valuable insights. What really stood out to you from this report?
Yeah, we'd love to hear your thoughts. As these AI data centers keep scaling up, how critical do you think integrated solutions like Flex's grid-to-chip will actually become? Is that the key differentiator going forward? Something to think about?